Welcome back to the deep dive, where we dig into a huge stack of sources. We're talking research papers, government reports, you name it, to pull out what you really need to know.
And today we have a big one.
A really big one. We're talking about tax deferral. And I know that sounds pretty dry, right? Like something for accountants.
It does, but it's not. It's
Okay.
actually one of the most powerful financial tools in the entire economy. It's about the strategic use of time.
Exactly. This isn't just shuffling forms. We're talking about billions of dollars in corporate strategy, huge international capital flows, and this is the critical part for today, we're bringing it all the way down to the difference between security and, well, insecurity for millions of seniors on fixed income.
That's the thread we're going to follow.
Okay, so let's set out the mission for this deep dive. We've gone through a mountain of material to see how this simple idea, just an authorized delay in paying taxes, creates this massive financial advantage.
Right.
So first, we'll unpack the mechanics of it. Corporate, personal income, international finance. And then we're going to zero in on a really specific and, I think, often overlooked application: property tax deferral.
And how that connects directly to the U.S. retirement income crisis, which is a huge structural problem. We'll use some very specific state programs as examples.
Yeah, that link between global corporate strategy and your grandmother's property tax bill is what makes this so fascinating.
So, starting point. The basic definition. Tax deferral is just a permitted delay in paying taxes until some future time.
Okay, but let's challenge that right away, because if it were just a delay, it wouldn't be this powerful. The sources make that incredibly clear. If you owe 100 grand in taxes, paying it in 5 years, well, you still owe 100 grand, right? But the reality is way more interesting.
It is, because the delay itself creates two huge benefits. The first one is obvious: the time value of money. The cash you didn't pay in taxes is working for you, earning returns, compounding.
That's the interest-free loan idea.
Exactly. But the second benefit, and this is the really seismic one, especially for personal income, is the rate difference. You can often defer the tax payment until a time when you are taxed at a much, much lower rate.
So the real goal isn't just kicking the can down the road. It's kicking the can to a place where the road is, much cheaper to travel on.
That's a perfect way to put it. You're shifting the tax from your high-rate 35% earning years to your lower-rate 15% retirement years. That's not just a delay. That's a permanent reduction in your total tax bill. And that is the core of this whole strategy.
Okay, let's start with the big players, corporations. For them, timing isn't just everything, it's the only thing. How do they actually do this?
Well, the name of the game is to legally reduce your declared profit in the current period. You either accelerate your expenses, recognize them sooner, or you delay recognizing your revenue.
To make this year's profit look smaller on paper.
Exactly. You're pushing that tax liability into the future. The assumption, of course, is that you'll have to pay more tax later to make up for it.
But is that really a net benefit? I mean, if you just have a bigger bill waiting for you, are you actually ahead? Or are you just playing a shell game with your cash flow?
That is the crucial question. And if the tax rate never changed, the benefit would only be that time value of money we mentioned. But that alone is huge.
So how do they do it? The sources pointed to one major example we should probably walk through.
Accelerated depreciation. This is the classic.
Right. Let's use that robot example from the source material because it makes it so clear.
Okay, so a company buys a big, fancy manufacturing system. Costs them $10 million.
Right.
Under the simple straight-line method, they depreciate it over, say, 10 years. That's $1 million expense on their books every year. Pretty straightforward.
$1 million a year for 10 years. Got it.
But tax codes often allow for accelerated depreciation. So instead, they might get to recognize, say, $4 million of that expense in year one.
Wow. Okay. $4 million instead of $1 million.
Right. And maybe $2 million in year two. They're front-loading the entire expense. That extra $3 million in expenses in the first year directly reduces their taxable profit.
And their tax bill.
And their tax bill. That tax saving is cash they get to keep right now. They can put it into R&D, they can hire people, they can do an acquisition. That cash starts compounding immediately.
But what happens in year 7 or 8 when the depreciation has all been used up?
Then their reported profits will be higher and their taxes will be higher in those later years, that's true. But the benefit they got from investing and compounding that early tax saving for all those years almost always outweighs the bigger tax bills at the end. It's that interest-free loan from the government again.
It really is. So what other tricks do they have up their sleeve? The sources mention more than just depreciation.
Oh, yeah. A big one is how you treat certain costs. There are these rules about capitalization versus expensing. Well, routine costs like office supplies, you just expense them immediately, lowers profit right away. But a huge cost, like building a new factory, you have to capitalize it. You treat it as an asset and write it off slowly over time.
Okay.
But the tax code creates these gray areas, things like R&D spending or maybe a big software purchase. The rules might give the company the choice to either capitalize it or expense it all at once.
And they always choose to expense it now.
If they want to lower this year's tax bill, absolutely. Taking $1 million deduction today instead of spreading it over 7 years is a huge immediate win.
And I remember reading about inventory, too, that LIFO and FIFO stuff.
Right. Last in, first out. It's another really clever timing tool. During a time of rising prices like we've seen recently, LIFO assumes that the newest, most expensive inventory you bought is the first stuff you sold.
Which makes your cost of goods sold higher.
Exactly. And a higher cost of goods sold means lower profit, which means a lower tax bill for this year. It's purely an accounting choice designed for tax deferral.
Okay, so let's bring this down to the individual level. For you and me, the game is the same, but the tools are different. It's all about pushing income into the future.
And we do that by maximizing our deductions right now, today. And people get really strategic about this. The sources show this fascinating pattern with state and local taxes.
This is the December effect. I love this. It's such a small, smart move.
It really is. So you know your state income tax payment is deductible on your federal return.
Right.
The payment might not be due until January or even April of next year. But a lot of taxpayers will choose to prepay it in December.
Why bother? It's only a month's difference.
Because it pulls that federal deduction from next year into this tax year. It's a way to accelerate the deduction to offset your income now, especially if this was a high-income year for you. You're not delaying the payment, you're accelerating the benefit of the deduction.
That is clever. But the real home run for personal tax deferral isn't these small moves, right? It's the big structural play.
It's the big one. It's all about exploiting progressive tax rates. The more you earn, the higher the percentage of tax you pay on your last dollar earned. That's your marginal tax rate.
So when you're in your peak earning years, say mid-career, you might be in the 32% or 35% federal bracket. Every extra dollar you earn gets hit hard.
Exactly. So you contribute, say, $10,000 to your 401k. You get to deduct that full amount from your income today. So you just saved yourself $3,500 in taxes right now at that high 35% rate.
And that 10 grand goes into the account, it grows, and you don't touch it until you retire.
Right. And now you're retired. Your income is much lower, maybe some Social Security, a small pension, and your withdrawals. You're now in the 15% or 20% tax bracket.
Ah, so when you finally pull that money out, you only pay tax at the new lower rate.
You pay 15 cents on the dollar instead of the 35 cents you would have paid years ago. The result is just staggering. You didn't just defer the tax, you permanently slashed the total tax you ever paid on that money by 20 percentage points.
Let's run the numbers on that because it's so important. Say you defer $100,000 at a 35% rate. It grows over decades to, I don't know, let's say $300,000.
Okay.
If you hadn't deferred it, you would have paid $35,000 in tax up front. So you'd only have $65,000 to invest.
Right. But by deferring, the whole $100,000 got to work for you. Now you withdraw the $300,000 in retirement and pay tax at, say, 15%. That's a $45,000 tax bill.
So you paid more raw tax dollars, $45K versus $35K.
You did. But your net result is astronomically better because the entire principal was compounding for decades, not just the after-tax portion. Your final take-home amount is way, way higher. It's probably the single most powerful wealth-building tool available to the middle class. Hashtag tax-C, tax-deferred retirement accounts.
And governments, of course, they create specific accounts to encourage this. The sources use the Canadian RRSP as a sort of pure model of this.
Yes, the Registered Retirement Savings Plan. It's the classic deduct now, pay tax later structure. You put money in, you immediately get to subtract that from your income for the year. That's the instant gratification.
The rate arbitrage we were just talking about.
Right. But the real engine of growth, the thing that makes the account so powerful over the long term, is the tax shelter on the growth itself.
What do you mean by tax shelter?
I mean that any interest you earn, any dividends you get, any capital gains from stocks going up, none of it gets taxed as long as it stays inside the RRSP.
Okay, that's a huge deal because normally you get a dividend, you pay tax on it that year, your stock goes up and you sell it, you pay capital gains tax.
Right. And that tax every year is a drag on your returns. It's like trying to run with a parachute on. If you earn an 8% gross return, maybe you only keep 6.5% after taxes eat away at it.
And that 1.5% difference every single year, compounded.
Over 30 or 40 years, it's the difference between a comfortable retirement and, well, not. The tax-deferred account lets your money grow at that full gross rate. The parachute is gone.
And here in the U.S., we have the 401k and the IRA, which work on a similar principle.
Oh.
Even the Roth versions, right?
Exactly. A Roth IRA is sort of the inverse. You pay tax now, and your withdrawals in retirement are tax-free.
So no deduction up front.
No deduction up front, but the core benefit is the same. The growth is completely tax-sheltered. If you buy a stock in your Roth for $10 and it grows to $100, that $90 gain is never, ever taxed. In a regular brokerage account, you'd have to give a chunk of that $90 to the government. It's all designed to get you to save by removing that single biggest enemy of growth, annual taxes.
Okay, now for the part that seems totally backwards. The sources talk about business owners sometimes choosing to prepay their personal taxes. Why on earth would anyone do that?
It sounds crazy, I know.
But
But it's a very specific, high-level strategy. It only makes sense in one scenario, when you know for a fact that tax rates are going up next year.
okay. A legislative change is coming.
Right. It's pure rate arbitrage again, just in reverse. You'd rather pay a 28% tax rate today than a 40% tax rate next year.
And this is mostly for owners of smaller businesses, like pass-throughs where the profit goes straight to their personal return.
That's the main use case. They can control their own compensation. So what they'll do is pay themselves a huge salary or a massive bonus in December of the low tax year.
Which inflates their income for this year, and they pay tax on it at the lower current rate.
Precisely.
But wait, what if the business doesn't have the cash on hand to pay out a massive bonus like that?
This is where it gets really sophisticated. The sources point out that the owner will often personally loan the money to their own business.
Seriously?
Yes, the business uses that loan to pay the owner the huge salary. The owner then declares that salary as income, pays the lower tax rate on it, and now the business owes the owner that money back as a loan.
So in the future, when tax rates are higher,
The owner can take a much smaller salary, just enough to live on, and the business can repay the loan principal to the owner, which is a tax-free event. You're just getting your own money back.
that is next-level planning. Using your dual role as owner and lender to shift income into the most favorable year. Wow.
It really is.
Yeah.
And it brings up a more basic rule that the sources emphasize for every business owner, which is to always make sure you use up your basic personal exemptions each year.
Because you can't carry them over.
You can't. It's a use it or lose it benefit. If you have a low-income year and don't pay yourself enough salary to use your standard deduction and exemptions, you've just left that tax relief on the table forever.
We should mention the risk here, though. This prepayment strategy is a big gamble.
It's a huge gamble. You're betting everything on the future success of your business. The sources are clear on this. If the business ends up failing a few years later, you've already paid all this tax up front on income that, in hindsight, wasn't really sustainable. And the losses you have in those final years might not be fully usable to get that tax back. It's an aggressive move.
Okay, so let's scale this up from a single business owner to a massive multinational corporation. The same principles apply, but the numbers have a lot more zeros.
And the geography is global. The core strategy here has always been to defer taxes on profits from foreign investments by keeping the money there. You retain and reinvest your earnings in countries where the corporate tax rates are really low. The goal is to keep the cash offshore, growing, and avoiding the higher tax rate of your home country.
So it's basically a global 401k, but instead of an account, you're using an entire country as your tax shelter.
That's a great analogy. It works exactly like that. ###B, the tax rate effect.
Let's get into the mechanics of it. The sources call this the tax rate effect.
Right, so the fundamental rule is this. As long as the profit earned by your subsidiary in, say, a low-tax country is not distributed back home to the parent company.
Not repatriated.
Correct. As long as it's not repatriated, it generally avoids being taxed in your high-tax home country.
So let's put numbers on it. Your subsidiary is in country X, where the tax rate is 12%, but your parent company is in country A, where the rate is 28%.
Perfect example.
Yeah.
As long as the profit stays in country X, it gets taxed at 12%. The moment you try to bring it home to country A, the tax authorities there are going to look at it and say, wait a minute, you owe us the other 16%.
So you just don't bring it home. You leave it there to grow.
You leave it there to grow.
Mm-hmm.
And this is especially powerful for things like intellectual property or financial assets, things that are easy to legally locate in a low-tax country.
But the sources say this advantage can become permanent, not just a deferral. How do you permanently avoid that extra 16%?
That happens in what's called a territorial tax system or an exemption system.
Mm.
Many countries, especially in Europe, have adopted this. The source specifically mentioned Germany for corporate shareholders.
What does that mean, a territorial system?
It means that the country basically says, we only tax the economic activity that happens within our borders. So if a German parent company brings profits home from its Irish subsidiary that were already taxed at Ireland's 12% rate,
Germany just says, fine, you paid tax there, we won't tax it again.
that's the essence of it.
Yeah.
The 12% Irish rate becomes the final permanent tax rate on that profit. It's no longer deferral at that point. It's permanent tax avoidance of the higher German rate.
Okay, wait. So you have these two different systems. One where the home country wants to collect the difference and one where they don't. The sources had names for these.
They did. The first one is the credit method. This was the traditional U.S. system. The home country taxes the foreign profit when it's brought back, but it gives you a dollar-for-dollar credit for the taxes you already paid to the foreign government.
So in our example, the U.S. would charge the 28% rate, but give a credit for the 12% paid to Ireland. You end up paying the 16% difference to the IRS.
Exactly. Under a pure credit system, your total tax bill is always the higher of the two rates. The benefit is purely the deferral, the time value of money.
And the other system?
That's the shareholder relief system, which is part of those territorial systems. The home country just exempts the foreign profit from any further tax. The foreign rate is the final rate. And that, you can imagine, creates a massive incentive to earn and keep profits offshore. ###HC. The interest effect, exponential growth.
But even under that old U.S. credit system where you eventually had to pay the full tax, deferral was still incredibly profitable. And that's because of the interest effect.
Yes. This is the power of compounding on a bigger number. Let's use a $100 million profit.
Okay.
In low-tax country X, with a 10% rate, the company pays $10 million in tax and has $90 million left to reinvest.
Got it.
In high-tax country A, with a 30% rate, they pay $30 million in tax and only have $70 million left to reinvest.
So they have an extra $20 million working for them offshore.
Right. And that's not just a one-time benefit. That extra $20 million starts earning a return immediately. If both investments earn 10%, the $90 million earns $9 million in profit. The $70 million only earns $7 million.
And the gap just gets wider every year.
It gets exponentially wider. The next year, you're compounding on $99 million versus $77 million. The principal base in the low-tax country is always bigger, so the earnings are always bigger. You're earning interest on the government's money, essentially.
So even if 10 years down the road, you finally bring all that profit home and have to pay the extra tax to the IRS.
It doesn't matter. The massive benefit you got from a decade of compounding on that much larger principal is already locked in. You can't undo that growth. The sources really stress this point. The interest effect is powerful, and it can't be completely eliminated even by later taxation.
All right, let's make a big pivot here. We're going from a multinational corporation with $100 million in offshore profits to a retiree on a fixed income, just trying to hold on to their home equity.
And it's an essential pivot because it shows how this concept of timing and taxes can be a tool for corporate growth, but also a vital lifeline for, social stability.
And the problem we're talking about is immense.
Yeah.
We have a huge number of retired people who simply do not have enough income to maintain their lifestyle.
This isn't just a feeling, it's a measured crisis. And the main metric we use for this from the sources is the National Retirement Risk Index, the NRRI, ###be up. The National Retirement Risk Index, NRRI data.
So tell us about the NRRI. Where does this data come from and what is it actually measuring?
The NRRI is a projection. It tries to calculate the percentage of households that are at risk of falling short in retirement. And it does this using data from the Federal Reserve Survey of Consumer Finances, or the SCF.
Which is the gold standard for this kind of household data?
It is. It's incredibly detailed. The NRRI looks at a household's projected retirement income, Social Security, 401ks, pensions, and compares it to their pre-retirement income to see if they can maintain their standard of living.
So what's the headline finding from all that data? What's the number that should really grab our attention?
The number is 50%. Approximately half of all working-age households in America are projected to be at risk.
Half. That's a staggering number. It's not a fringe problem.
No, it is a mainstream middle-class problem. The data is very clear that this isn't just about the lowest income households.
Right. The sources break it down by income level. What does the risk look like for middle and even top income households?
Well, for the middle income group, the risk is often that they've saved, but not nearly enough, and they're completely exposed to stock market volatility in their 401ks. For the top third, it's a different kind of risk.
What's that?
It's often that they have a high net worth tied up almost entirely in their home, but very little liquid income. And they underestimate just how long they're going to live and how incredibly expensive healthcare is going to be in their 80s and 90s. They're house rich and cash poor. #C, structural reasons for the increased need for resources.
So why is it so much harder for this generation? Why do they need so much more money than their parents or grandparents did for retirement?
There are three big structural forces at play. The first is just demographics. We're living so much longer.
Right.
If you retire at 65 and live to 95, that's a 30-year retirement you have to fund. That's a huge increase in longevity risk compared to past generations.
And the costs during that longer retirement are also going up, especially one particular cost.
Healthcare is the elephant in the room. Even with Medicare, the out-of-pocket costs, the premiums for supplemental plans, the co-pays, they are rising much faster than inflation, and they can absolutely devastate a fixed-income budget.
And the third factor is something that affects all of our savings: interest rates.
Yes, the decades-long period of very low interest rates has completely changed the game. The old rules of thumb, like the 4% rule for safe withdrawals, were based on a world where you could get a decent, safe return on your money.
But when savings accounts pay close to zero and bonds pay very little, you need a much bigger pile of money to generate the same amount of annual income.
A significantly bigger pile. To generate, say, $50,000 a year in income today, you need a much larger nest egg than you would have 30 years ago. It's a simple mathematical reality. #D, declining traditional income sources.
So the need for resources is way up. But at the same time, the traditional sources of income are providing less. Let's look at the two big ones: Social Security and private pensions.
Starting with Social Security, the benefits have been quietly getting less generous relative to what people used to earn.
How so?
The most direct way is the increase in the full retirement age, from 65 up to 67. If you still claim your benefits at 65, you're taking a permanent reduction compared to waiting. It's an actuarial cut in benefits.
And there are other little cuts happening too, right? In your actual take-home check.
Two big ones. First, Medicare Part B premiums are usually deducted right from your Social Security check, and those premiums keep going up. And second, more and more people are having to pay income tax on their Social Security benefits.
Why is that?
Because the income thresholds where that tax kicks in were set back in the 80s and have never been adjusted for inflation. So what was once a tax only for the wealthy now hits a huge chunk of the middle class.
So the program is just eroding around the edges, and that's before we even talk about its long-term financial health.
Right. The system has a projected 75-year deficit. Everyone knows that at some point Congress will have to act, and that could mean further benefit reductions or tax increases. There's a lot of uncertainty.
So that's pillar one. What about pillar two, the private system? Why isn't that picking up the slack?
Two reasons: coverage and adequacy. The big shift from pensions, where the company guaranteed you an income for life, to 401ks has put all the market risk, longevity risks squarely on the individual's shoulders.
And not everyone even has a 401k.
Not by a long shot. There's no universal coverage. Millions of people, especially those in smaller businesses or the service industry, have no workplace retirement plan at all. They are 100% reliant on Social Security.
And even for the people who do have accounts, the balances are just not enough.
Often shockingly low. The median balance for people nearing retirement is nowhere near what's needed to fund a 30-year retirement with high healthcare costs. The system is failing to solve the problem for half the population. #show E, property taxes and economic insecurity.
Okay, so this brings us right to the specific pressure point that property tax deferral is designed to fix. When your income is flat and your savings are low, that annual property tax bill becomes a real threat.
It becomes an acute source of financial stress. And to measure this, the sources point to a different metric, the Elder Economic Insecurity Rate, or EER.
What's that?
It's a much better measure than the federal poverty line. It calculates the share of seniors who don't have enough income to cover their actual basic living costs, housing, food, healthcare, transportation, in the specific place where they live.
So it's a real-world measure of vulnerability. And how does this connect to property taxes?
There's a very strong correlation. The data shows that 7 of the top 10 states with the highest rates of elderly insecurity also have high property taxes.
So the property tax bill is a major driver of this insecurity.
It's a huge driver because it keeps going up as home values and local budgets increase. But a senior's income from Social Security or a pension is mostly fixed. It's a recipe for disaster.
And this creates that paradox that the sources highlighted, where rich states can be just as dangerous for seniors as poor states.
Exactly. This is the critical finding. States you think of as wealthy, Massachusetts, New York, New Jersey, California, have rates of elderly insecurity that are just as high as low-income states like Mississippi or Louisiana.
How can that be?
Because the crushing burden of property taxes in those high-cost states completely wipes out the benefit of any higher savings they might have. The property tax acts as a relentless, escalating tax on a fixed income, trapping seniors who are, again, house-rich but cash-poor.
So against that backdrop of this really widespread acute problem, property tax deferral comes in as a very direct, almost surgical solution. Hashtag a mechanism and immediate benefit.
It is. For a senior on a fixed income, that property tax bill can be the single biggest and most frightening check they have to write all year. These deferral programs simply allow them to not write it.
As long as they meet the criteria.
Right, they have to meet the age, residency, and income rules. But if they do, they can delay paying that tax for as long as they continue to live in their home.
And what's the immediate effect of that? What does that mean for them day to day?
It's an instant increase in their disposable income. That's money that can now go towards better food, or medication copays, or fixing the furnace. It removes a massive piece of financial anxiety from their lives.
The sources compared this to getting an annuity.
It's a very good comparison. It's like the state is giving you a reliable annual cash payment, or in this case, a payment relief, equal to your tax bill every single year. You're essentially tapping into your home equity in a very slow, safe, and structured way. Hashtag B state locality economics.
Okay, but what about the town? The town needs that property tax revenue to pay for schools and police. How does this not blow a hole in their budget?
This is the most brilliant part of the policy and why it should be so much more popular. The taxes aren't forgiven, they're just deferred.
They have to be paid back eventually.
They have to be paid back with interest when the homeowner either sells the house, moves out, or passes away. The town places a lien on the property, so the debt is secured by the house itself.
So the local government is acting like a bank with the house as collateral?
A very safe bank. And this is the key takeaway from the sources. The program has no long-term cost for the state or the town. They are a secured lender. They get all their money back plus interest. It's a cash flow timing issue for them, not a permanent loss.
So they get to solve a major social problem for their most vulnerable residents at essentially zero net cost to the other taxpayers. That seems like a political no-brainer. Hashtag with tax program availability and standard requirements.
You would think so, but the reality is these programs are shockingly rare.
Yep.
Only 24 states currently offer any kind of property tax deferral for seniors.
So more than half the country doesn't have this tool in their toolbox at all. For the states that do have it, who runs the show?
Generally, the state legislature passes the law that creates the framework, but the programs are actually administered at the local level by the town or county.
And that gives them some flexibility.
It does. It lets them tweak things like the income limits or the interest rates to match the local economic conditions, which is really important.
So what are the typical requirements to get into one of these programs?
The baseline, pretty much everywhere, is you have to be 65 or older, you have to own and live in your home, and your household income has to be below a certain level. The most common baseline figure cited was around $20,000 a year.
So really targeted at the low-income group. And what's the cost to the senior? What kind of interest rate are they paying on this loan from the town?
The standard rate seems to hover right around 6%. And that rate is really important. It needs to be high enough to compensate the town for the delay, but low enough that it doesn't feel predatory to the senior signing up for it.
Okay, to make this all feel really concrete, let's look at the case study from the sources. Massachusetts, one of those high-cost, high-insecurity states. And they have 3 different ways they try to handle this.
Right, so the first one is the circuit breaker, and this is a pure subsidy. It's a state-funded welfare program, not a deferral.
So this is the state just giving people money?
Essentially, yes.
Right.
It's a refundable tax credit for homeowners or renters over 65, and it's designed to kick in, like an electrical circuit breaker, when their housing costs become an overload on their income.
How does it calculate that overload?
The formula is pretty specific. The credit is based on how much their property taxes plus half their water and sewer bill exceeds 10% of their total income.
So it's designed to help only when that burden becomes really disproportionate.
Exactly. If your income is, say, $40,000, 10% of that is $4,000. If your property taxes and water bill are $7,000, then you have $3,000 of what the state considers an excessive burden.
But you don't get the full $3,000 back.
No, the credit is capped. The maximum you can get is $1,130. And there are strict income and property value limits to make sure it's targeted. It's not for people living in multi-million-dollar homes.
And since this is a direct handout from the state, what's the price tag?
It's significant. The sources say this program costs the state of Massachusetts about $80 million a year.
Okay, so that's the state level subsidy. The second program is also a subsidy, but it's run by the towns themselves.
Right. These are the local senior property tax exemptions. This is a much simpler program.
How does it work?
It's just a flat discount on your tax bill. The standard amount is a $500 exemption. They just knock $500 off what you owe.
And who qualifies for that?
The requirements are a bit tighter. You generally have to be 70 or older and, again, meet a bunch of income and asset tests that are set locally.
And since the towns are the ones eating this cost, not the state, I assume they have some control over it.
They do. A town can choose to increase that exemption from $500 up to $1,000. They can also lower the age from 70 down to 65 if they want to be more generous. It's a local decision with local money. In 2019, this cost the towns about $10 million in total.
All right, so after those two subsidy programs, we finally get to the actual deferral option, the one that's not a handout.
This is the one that's a loan. Again, the state law authorizes it, but the local government runs it, and they have a lot of flexibility.
Let's talk about that flexibility.
Yeah.
The state's baseline income limit is only $20,000, which is really low.
It's poverty level. And towns know that the problem is much bigger than that. So the law allows them to raise that income ceiling all the way up to $60,000.
That's a huge difference.
It is, and it's critical. It allows the program to help that vulnerable middle-income group we talked about, the house-rich, cash-poor seniors who would never qualify for the other programs but are still struggling.
What about the interest rate? Does the town have control over that too?
They do. The state sets a maximum ceiling of 8%, but a town is free to set a lower rate if they want to make the program more attractive.
And there's a safety valve built in, right? A limit on how big the loan can get.
Yes, the lien cap. This is really important protection. The total amount of deferred taxes plus all the interest that is built up can never be more than 50% of the market value of the house.
So it guarantees the town gets its money back, and it also guarantees that the senior's family will still inherit a substantial amount of equity.
That's the dual purpose. It protects both sides.
Okay, now for the part of the Massachusetts plan that really made me sit up, the repayment terms. There's a very specific interest rate spike that happens right at the end.
This is the fine print, and it's there for a reason. So when the house is sold or the owner passes away, the loan becomes due. The estate has 6 months to pay it back.
And during that 6-month window?
During that specific 6-month period, the interest rate on the outstanding balance jumps to 16%.
16%. That's double the maximum rate during the deferral period. Why so high? That seems almost punitive.
It sounds like it, but it serves a very specific purpose. It's a powerful motivator for the heirs or the estate to settle the debt quickly. It stops them from just sitting on the property for years while using the town as a cheap source of financing. It ensures the town gets its money back in a timely manner so it can continue to fund its operations. It's an aggressive but effective mechanism. Hashtag tag outro.
So when you pull it all together, this deep dive shows that tax deferral is so much more than some boring accounting rule. It's a fundamental economic strategy.
It really is. We saw it at every level, from the huge multinational corporations using things like accelerated depreciation or offshore havens to maximize the power of compounding.
All the way down to an individual saver using their 401k to shift income from a high tax year to a low tax year. The principle is exactly the same. Use timing to either maximize your growth or minimize your final tax bill.
But for me, the most compelling part is its use as public policy. These property tax deferral programs are a direct answer to a huge structural economic problem.
Yeah, the NRI data is stark. Half of households are at risk. And when you have rising property taxes acting like a weapon against people on fixed incomes, this is a targeted solution.
And it's a solution that, as the Massachusetts case shows, can be structured as a self-funding loan, not just a welfare subsidy. It's a powerful, elegant idea.
Which brings us to our final provocative thought for you to take away. The sources are absolutely clear that these property tax deferral programs are, in the long run, zero cost to the government. They are secured loans that are guaranteed to be repaid with interest.
And yet, only 24 states have one.
Exactly. So, if this tool provides critical relief, if it helps solve a retirement crisis that we know affects the middle and even upper middle class, and it doesn't cost the taxpayers a dime, What's stopping it from being adopted in all 50 states?
Is it just a political fear of putting liens on seniors' homes even when the senior is asking for it and benefiting from it? Or is it just a lack of education and awareness at the local government level?
That gap between the proven need, the quantified risk, and the limited availability of a zero-cost solution. That's definitely something to think about the next time your local property tax bill comes up for debate.
Mm-hmm.
That's all the time we have for this deep dive. Thanks for joining us. We'll see you next time.